Good evening, everybody. This is Mark Perkins that will be talking to you tonight. And tonight what we will be focusing on is the Commitment of Traders Report. Now this is a fairly advanced webinar, so it is being recorded and should obviously provide you some opportunity to go through it at a further date as well. But it was, I think, just necessary just to have a little bit of advanced fundamental analysis as well, just so we can get an idea of what's going on in the market. Okay, so what I will be talking about today is just explaining what the COT report is, where you can find the report, some trading strategies that you can utilize, how to pick highs and lows there, and just finally where we can have a look at some websites that incorporate COT charts. Okay, but let us begin with what is the COT report itself. Firstly, it comes from the Commodity Futures Trading Commission, or CFTC, which publishes a Commitment of Traders report every Friday around 2:30 p.m. Eastern Standard Time. Okay, now because the COT measures the net long and short positions taken by speculative traders and commercial traders, it's a great resource to gauge how heavily these market players are positioned in the market. So it gives us an idea of what the big boys are doing in the market, and then we can obviously adjust our trading strategy accordingly. You might be asking yourself, why do spot FX traders need to use data from the FX futures market? Well, firstly, the spot FX is traded over the counter, and transactions do not pass through the centralized exchange like the CME or the Chicago Mercantile Exchange. So what's the closest thing that we can get our hands on to see the state of the market and how the big players are moving the money? Well, it's pretty much this. It's the Commitment of Traders report from the futures market. All right, so where can we find the actual COT report itself? You can Google the COT report, or you can go straight to the CFTC website. And what you're going to basically do there is, once the page is opened up, just scroll down a couple of the pages to, and this is fairly important, it's the current legacy report. And click on short format under futures only on the CME exchange. Just access the most recent COT report. So you'll see, it'll look what, I've taken a screenshot of it down here on the right hand side. So what you basically want to look for is the Chicago Mercantile Exchange, futures only, short format. And that probably is the easiest format that you're going to get. I mean, it is quite a convoluted report, but I'm obviously going to take you through it. All right, so as I say here, it may seem a little intimidating, but just press Control F or whatever you use to find your function in your browser, and type in the currency you want to find. So, for example, if I want to look for the pound British sterling, you'll be taken to something that looks like the following. All right, so this is basically the short format report that you will get. All right, and this is basically for the British pound sterling. What I'm going to do is I'm just going to explain to you how we derive all these numbers, who the big players are here, and hopefully after going through that it'll make a bit more sense to you, because it can be a little bit daunting the first time you look at it. Okay, so as I said, it's not pretty, but if you understand the basic layout and what the figures actually mean, it'll soon begin to make sense. Firstly, this is one report for one exchange on one contract, and this is essentially the shortened form. So you have various different reports for different exchanges and for different products. So this is the one that we're focusing on in terms of the British pound. Okay. The CFTC provides this report in both the long and short format, and also for both futures and options combined. We're just going to focus on the futures one. All right. Using the short form for futures only, which is what you're looking at in the above example. Secondly, each report will contain all the futures products promoted by the exchange, so each exchange report will include the above details for each contract, whether it's commodities, equities, indices, or indeed foreign exchange. Okay, so there's a variety of trade groups that we have here. They are namely the commercial, non-commercial, and non-reportable. I'm just going to go through the definition of each of those. Firstly, the commercial means traders who are involved in futures trading because they are involved in the production or processing or selling of an entity or commodity, and therefore use futures contracts primarily to hedge futures prices. So a classic example here would be a farmer hedging against falls in the future price of cattle or corn. Then next we have our non-commercial, which is in effect means speculators, like your typical hedge funds or large institutions So purely buying and selling contracts for speculative profit, both long and short. And then finally, the rats and mice, the non-reportables, which in essence is everyone else. This includes all the small traders buying 1 or 2 contracts. In other words, that's you and me. Okay, so just some of the other report terminology that I'm just going to go through, and then I will take another look at the report, so hopefully when I mention all the words there, it'll make sense to you. Okay, going long, as most of you will know, means the number of contracts which are long expecting prices to rise. Short means the number of contracts expecting prices to fall. A spread means the extent to which a non-commercial trader holds equal long and short futures positions. In other words, a spread trade where the trader is long one contract and short another. All right, open interest is the total number of futures or option contracts not yet offset by a transaction by delivery or expertise. Finally, the number of traders is the total number of traders who are required to report positions to the CFTC. Okay, so let's go back and just have another look at the actual report now and just see how we arrive at all the numbers. You'll obviously have your various different columns there, your non-commercial, commercial, and non-reportable positions. And what we basically going to look at here is how do we arrive at these total long figures, okay, initially. So what we'll do is we'll take from non-commercial, commercial, we're going to take the long figures, we're going to add those all together as well as our spreads, and that is how we're going to arrive at our total of 128,079. Okay, so that is basically explaining the total long positions. Next, we will be looking at the short positions, and we'll take the short from the non-commercial, the short from the commercial, and include the spreads. That will you total those 3 totals, and you will arrive at 107,230. Then let's just take a look at our open interest situation, and if we have a look at this figure of 16,954, that in essence is our open interest of 145,033 less our long total of 128,079, and that's how we basically arrive at our long interest there. Same story for our short of 37,803. We're going to get our 145,033 less our 107,230 on the short total, and that will just basically how we arrive at 37,803. Carrying on through the actual report itself, as we move on down, this is basically the change in open interest over the last week. Okay, the next row down we give it as a percentage amount in terms of for each category of traders, and then finally, as I mentioned earlier, the number of traders who basically have to say how many positions they've got in various different long or short situations. All right, so let's take a look at a COT trading strategy, and I'm sure probably most of you would have guessed this by now. But one way to use a COT report in trading is to find extreme net long or net short positions. All right, so we're looking for a longer term type of trade. All right, finding these positions may signal that a market reversal is just around the corner, because if everyone is long a currency, who's left to buy? Well, essentially no one. Same story. And if everyone is short the currencies, who's left to sell? No one. All right, so let's take a look at this chart of the euro dollar from timing charts there. Okay, and I'm going to show you that website at a later stage in the presentation. Okay, but on the top half we've got the price action of the euro dollar going on. At the same time, on the bottom half we've got data on the long and short, or the net positions, if you like, of the euro futures, divided into 3 categories. We have our commercial traders in blue, our large non-commercial and small non-commercials in green and red respectively. All right, so let's take a look at this. Let's ignore the commercial positions for now, since those are mainly for hedging, while small retail traders aren't relevant. Okay, so let's take a look at what happened midway through 2008. All right, so that's basically, hang on, let me get my little positioning tool out here, my spotlight, if you will. All right, so we're going to be looking around about this portion here. As you can see, the euro dollar made a steady decline from July through to September. And as the value of the net short positions of non-commercial traders, which is the green line down here, dropped, so did the euro dollar. So as this is dropping down, so did our non-commercial traders. in the middle of September, net short positions hit an extreme of 45,650. Okay, soon after, investors started to buy back their euro futures. And meanwhile, the euro-dollar rose sharply from about 124 to a high near 147. So we saw a massive increase there over that period of time. Over the next year, the net value of euro futures position gradually turned positive. So as expected, the euro-dollar eventually followed suit, even hitting a new high around 151. All right, so in early October 2009, all right, euro futures net long positions hit an extreme of 51,000 before reversing. Okay, and shortly afterwards, the euro-dollar began to decline as well. Okay, so here we go. So an extreme long reversal followed. Okay, here was an extreme short, the reversal followed. Okay, so just need to pair those two together there down at the bottom as well. Okay, so just by using the COT as an indicator, you could have caught two moves from October 2008 to January 2009, and then November 2009 to March 2010. The first was in mid-September 2009. Okay, if you had seen that speculative traders' short positions were at extreme levels, all right, you could have bought euro-dollar at around 123. Okay, down here to around about this position here. This would have resulted in almost a 2,000 pip gain in a matter of months. All right. Now, if you had also seen that net long positions were at an extreme in November of 2009, all right, so at these portion here, you would have had sold the euro-dollar, and you probably would have grabbed about 1,500 pips or somewhere in that vicinity on this down move. Okay, so just with those two moves, you know, you would have grabbed a total of 3,500 pips just off two trades. When last did you do a trade like that? It's been a long while for me, that's for sure. All right, so let's just while I'm just taking off my spotlight here, just have a look at that chart and go through it again. I do come back to it at a later date with further examples. Okay, so let's have a look at picking tops and bottoms. All right, so these are ideal places to go long and short, you know, where the sentiment is at a real extreme. If you notice from the previous example, the speculators, which is our green line down here, and the commercials, which is our blue line, gave opposite signals. All right, so they'll converse to each other. While hedgers buy when the market is bottoming out, speculators sell as the price moves down. Okay, so let's just say that again. Hedgers buy when the market's bottoming out because they're obviously looking for it to increase. Speculators will speculate the price will decrease over a portion of time, and that's when they're looking to trade. Okay, so hedgers are bearish when the market moves to the top, while speculators are bullish when the price is climbing. All right, as a result, speculative positioning indicates trend direction, while commercial positioning could signal reversals. If hedgers keep increasing their long positions while speculators increase their short positions, a market bottom could be in sight. If hedgers keep adding more short positions while speculators keep adding more long positions, a market top could occur. And of course, it's difficult to determine the exact point where sentiment extreme will occur, so it might be best just to do nothing until signals of an actual reversal are seen. You know, and like I do suggest waiting on that. It's very difficult to pick the absolute the tops and bottoms. Okay, because speculators follow the trend, they can match, well, they catch most of the move, but are wrong on essentially the turning point. All right, so like we're waiting for it to move back around before they actually get involved. Commercial traders, on the other hand, miss most of the trend except when the price reverses. Until the sentiment extreme occurs, it would be best to go with the speculators. Okay, but the basic rule is this. Every market top or bottom is accompanied by a sentiment extreme. However, not every sentiment extreme results in a market top or bottom. Okay, say that again. Every market top or bottom is accompanied by a sentiment extreme, but not every sentiment extreme results in a market top or bottom. Okay, so let's just put some of these numbers into action here. There's obviously a couple of different ways we can do it. Now that we know how to determine sentiment extremes, what's next? Recall well, if you recall that not every sentiment extreme results in a market top or bottom, so we'll need a more accurate indicator. Calculating the percentage of speculative positions that are long or short would be a much better gauge to see whether the market is topping or bottoming out. Okay, and the equation to calculate the percentage long and percentage short is quite easy, really. If you basically just have a look at the percentage long is the number of long contracts divided by the number of long contracts added to the number of short contracts. Conversely, the percentage short would be your number of short contracts divided by your addition of long contracts and short contracts. To illustrate this better, let's go back a few years and see what happened with the Canadian dollar futures. Going through the COT reports released on the week ending August 22nd, 2008, speculators were net short 28,000 cents contracts. On March 20th, 2009, they were net short 23,950 contracts. So just basically from this information alone, you would say that there's a higher probability of a market bottom in August since there were more speculators than there were short in that period. However, a closer look would show that 66,726 contracts were short while 38,641 contracts were long. Out of the speculative positions in August, 63% were short positions. Okay, so let's take a look at that. All right. Okay, so this is the area we're talking about here. All right, so this is where we had 63% of short positions. All right, and what we actually continue to see happening was a move further to the downside. All right, and when we got to around about this position over here, we actually had a look at our ratio and we realized that we had a much better short ratio of 78.9, which is this percentage here. And if we just basically have a look at what went carrying on going forwards here, we'd see a massive increase there to the upside. Just on the next slide, I'm just going to tell you a little bit more about that. Okay, so as I mentioned, on the other hand, there were just 8,700 long contracts. So we had, let's just go back there, we had 66,000 versus 38,000 here at this initial point here where it was 63%. Okay, on the other hand, as I mentioned here, there were 8,700 contracts versus 32,000 short contracts in March. You know, so there was 79% of the speculative positions were short positions. Okay, thereafter a high chance that a bottom will occur and a short as opposed to just 63%. So there was a much better chance of there being a bottom created. The bottom in fact did not occur around August 2008, which was on this, well this is the chart itself. Okay, so this is just the same chart. So it didn't happen here at this point. It actually eventually bottomed out here, which coincided with our 79%. Okay, the Canadian dollar continued to fall over the next few months. The percentage ratio, as I mentioned here, went to 79% in March. The CAD hit a bottom around 77 US cents. Okay, and then that's basically when we saw our upshift here. Okay, so just some useful websites, as I said. The first one is timingcharts.com, and I'm going to go to that right now. The other one is to get the actual COT report. I want you to go to, well, just Google, really, COT report, and it'll take you through to the CFTC website. But let me just take you through to that timingcharts.com, and this is basically it, which is www.timingcharts.com. And when you first go on, you basically have a choice of symbols that you can choose from. You've got all the sort of the majors here. I've got it set to the dollar index here. You can select if you want it to be linked. I go with linked because we don't want just a separate futures contract. I want the full bank shoot. You can choose between day, weekly, or monthly, a bar chart or a candle chart. I stick it on candle chart because that's just what I'm used to seeing. You can basically decide whether you want it to be on a dark background or a light background. You can add different indicators on here as well. So I've just put on a moving average of 100 points here as well, or 100 a daily DMA. And this essentially here, if you click on COT, this is what's going to basically come up on the left-hand side here. You can select, firstly, which database you want it from. I usually only go from futures only, as I mentioned. This position here is just the net position, okay, which is this down here at the bottom. Okay, so as I mentioned, it gives us your commercial, your large, your speculatives, which is what we've talked about before. Okay, you can add on additional panel as well, should you wish, just if you want to do a sort of a further in-depth look at it as well. But really, guys, this is purely just to get an idea of market sentiment, all right, and just to see what the big boys are doing. If you can get a handle on what they're doing in trade, along with what they are saying, chances are pretty good that you're going to get a good long-term trend or trade correct. But that is it really for today, guys. It's more a case of getting on it and doing your analysis of it. I would probably go back and watch this again, because it just takes a little bit of time to digest all of this that I've talked about tonight. But I'll leave a few minutes here at the end just to discuss it, if you have any questions. But thanks very much for listening in.